Hello and welcome to another episode of the ICC Academy Livecast, a new podcast series where we take a deeper dive into global business trends and ideas. I'm your host, Thomas Paris, and in this episode, we will discuss how macroeconomic and geopolitical trends are affecting growth in emerging Asia. Our special guest today is Sam Ahmed, Managing Director and Founding Partner of Deriv Asia, a consultancy firm with experience in Asian financial markets. Thank you so much for joining us, Sam. How are you doing?
Not bad at all, not bad. Thank you. It's a pleasure to be here.
So as a newcomer to the ICC Academy audience, tell us a little bit about your background and your current role.
Yeah, sure. So Deriv Asia is a global consultancy looking at financial markets globally, derivatives markets, asset management. Our clients are mainly banks, central banks, asset managers, pension funds, and regulators. I manage the Asian franchise, so anything that goes on here, I'm the lead. Typically, we focus on three things. One's business development, and that is, an example of that can be a bank that comes to us, a client, a regional bank that says, or a local bank that says, look, we want to build our prime brokerage business, we want to build our custody business. It could be an asset manager that wants to take more exposure to frontier economies and asks us to build a benchmark. So those are examples. We also do a lot of work on risk and regulatory, on the risk and regulatory side. So for example, on things like FRTB, SACCR. Right now we're working quite a bit on IBOR, which is the LIBOR reform initiative. And we do a lot of work on technology, specifically helping regional institutions to overhaul their front, middle, back risk technology. And in that respect, I also have to say we do quite a lot of work with blockchain, AI, and cloud development here. Right. So as we go on, I think, it'll be more apparent what we do, because I don't want to take up too much of your time in explaining. Yeah.
No, and we'll definitely loop back around to the technology and the blockchain side.
Yeah.
But to kick things off, we brought you here because of your unique perspective.
Sure.
So when it comes to Asia and emerging markets, what is your view on the landscape today at a global perspective?
Okay, I think that's a good start. So let's, given that you've asked for a global perspective, I think it's important because we can't look at Asia without putting it into a global perspective context. So we'll start off with the macro picture. If you've seen the latest IMF stability report, they've projected global growth to be around 3%. And the reason why that's interesting is it's just above the IMF recessionary benchmark of 2.5%. So we're just above a recession, from global recession, which is interesting. And that's why it's got central bank policymakers, fairly cautious and global central bank policymakers are moving towards an easing bias. And not only just global policymakers, even Asian central banks, BOT, POSB, sorry, I shouldn't be saying acronyms, but China, Thailand, MAS of Singapore, Bank Negara of Malaysia, Philippines, they're all moving towards an easing bias. So what's happened from a global investor perspective is this has forced them once again to look for yield, right? And that means, taking on added risk. So moving from sovereigns to corporates, moving from sort of a high-grade advanced economy towards emerging markets, right?
Right.
If you don't mind, can I just add a very interesting survey we did for a client? So one of the large Asian institutions gave us a market intelligence report. Very simple, just a few basic questions. They wanted us to interview about 15 global asset managers and come up with some answers about Asia. They needed this report to see how they're going to basically launch products for next year. They asked a simple question, right? for us. And we took this out to the various asset managers globally, and we asked, why would you invest in Asia in 2020? Very simple question, right? But the answers are very interesting. 56% predictably said yield. Okay, that's not uncommon, right? Some people view Asia, some institutions, as purely a yield play because of inherent risks here. Interestingly enough, 31% said for long-term growth prospects. Now that opened my eyes. This was new. Long-term growth prospects. Very interesting. Now 11% actually said they viewed Asia as a relatively safer and more stable environment. Now that was a complete eye-opener. 10 years ago, you would never expect any investment manager to say, oh, you know what? We view Asia relatively stable and secure compared to the rest of the world. But that's, given the geopolitical situation that we're in, given the apparent distrust between global superpowers like the US, Russia, China, given, what we've seen in Europe with Brexit, given all the proxy wars that are going on and the trade wars, we are seeing finally something tremendous going on. We're seeing a whole paradigm shift where Asia is no longer just let's pick up some yield, but really a strategy to invest in the longer term growth of this region, which is, for me, it was an eye opener and something very, very refreshing to hear.
Right. So you mentioned 31% of the responders saying that they're investing in Asia for the long-term prospects. Can you elaborate a little bit on where this growth itself is coming from?
Oh, that's a great follow-up question. Yes, Thomas. So, look, I would at this stage look at the macro trends, right? Significant macro trends are growth in the middle class in Asia, the urbanization that's taking place from all the surrounding regions, from all the villages and the rural places into the cities, and the growth in the elderly population. Now, let's just look at the McKinsey report that came out this year, right? By 2040, Asia is projected to be 50% of the global GDP, right? 40% of the global consumption in terms of consumer goods, and the middle class in Asia is set to be 3 billion by 2040, right? That's massive. 3 billion Asian middle class. So what does that mean in terms of just what they need, in terms of their demand? Well, they'll need consumer goods, healthcare, hospital, housing, cars, transportation, infrastructure. The main question is, who will provide these? In Asia, unlike in Europe and the US, this is where corporates and particularly SMEs come in. They are the backbone of Asia, right? And I don't want to inundate you with statistics, but here's just the last few, right? So World Bank figures show that SMEs currently contribute to 40% of the Asian GDP. That's significant. More importantly, 65% of the private sector jobs in Asia are held by SMEs. The big issue that we're facing now in Asia is they have challenges to financing. And if they are not financed adequately in, using stable and long-term means, we may see some of that optimistic projected growth that everyone's talking about fade away. So it's key that financing SMEs and corporates is the key.
Right. So I want to touch on that a bit because you did mention the challenges to the financing.
Yes.
But there are a lot of well-established banks in Asia with healthy balance sheets. Shouldn't they be able to finance growth in the region?
Yeah, absolutely. I mean, that's absolutely a logical question to follow up with. So banks in Asia have traditionally played a much larger role than banks in other parts of the world. And if you look at some of the Asian banks, the Chinese state banks in particular, ICBC, BOC, they are the largest in the world. And that's because Asian institutions have always relied on banks for financing. Even today, they are relying on banks for financing. But let's look at, why. Well, first of all, banks in Asia have organic deposits, right? So they have a naturally lower cost of capital, so they can offer financing at a much more competitive rate. They also have, Asian institutional clients are different from Europeans or Americans. They are pretty loyal once they have a banking relationship. They don't go shopping too much. It might have changed recently, but there is a symbiotic relationship between banks and SMEs, banks and financial institutions in Asia. But having said that, let's look at SMEs, because you've asked an important question. The Deloitte report on Southeast Asia digital banking says the following, right? The countries in Southeast Asia whose SME rely on banking are as follows. Indonesia, you'd be surprised, only 6% of SMEs, exactly, take funding from banks. Malaysia and Thailand, a bit healthier, around 50% take funding from banking. Singapore, 60%. But if you just think about that in the whole context of things, right? Indonesia, I'm not too surprised about, because, they have very high net worth, high net worth individuals and families. So it could be that a lot of these SMEs have connections or relatives in those positions, right? Malaysia, Thailand, and Singapore, we need to find out why is this. And one of the main reasons is, the regulators in those countries are really weary on, ensuring that they follow global regulations. And as you know, that post the financial crisis, Basel III came out with very stringent credit risk policies and methodologies, right? So Basel III was really good at ensuring that the risk a bank took was tied in with the capital they had to set aside for the risk. It's called RWA, risk-weighted assets. And when it comes to SMEs, there's a whole lot of reasons why, from a credit standpoint, they're viewed as weak institutions. And there's a whole host of reasons for that. One, there's a lack of data on SMEs. Two, it's not as if SMEs are sitting on a whole lot of assets, right? They're not sitting on a whole lot of assets. Their main assets are their own inventory, which they can't even pledge as collateral to many banks. That's the main reason why, because of regulations, because the RWA for banks when they face an SME is fairly high. So the cost of borrowing for SMEs is high. But one more interesting stat that I need to share with you is this. Do you know that banks in Singapore for SME lending are making ROEs close to 25 or even 30%? Massive, right? That is absolutely massive. So if you combine the two things I talked about, banks are really cautious on ensuring that they abide with Basel III regulations and they don't put sort of risky assets on their balance sheet, right? Second, they are already making 25 to 30% ROE. If you combine these two, why would they venture out and welcome, smaller SMEs into their portfolio? They're happy as they are, right? So I think that's the main reason why we can conclude and say that banks play an integral role. But unfortunately, when it comes to SME financing, they'll have to rely on more than just banks.
Of course. Yeah, no, that makes sense. So to bounce off exactly what you just said, if we're looking at filling in the gap and banks are not able to do that in emerging Asia, should we be shifting our gaze to non-bank players? Things that come to mind are P2P lenders or crowdsourcing platforms.
Oh, yeah. Okay. So again, great question, right? So, so there's P2P players that came in really strong back in 2013, 14, 15. Especially the Chinese ones. But let's take a step back and ask a fundamental question to everyone, right? Why would P2P platforms surge in popularity? Why is it that, the region welcomed them? And for this, let me also put a caveat in. Let's switch from SME to retail, okay? The topic today is about financing Asia. We're not specifically talking about SMEs. So I wouldn't mind just using this example, if you don't mind, on the retail segment. Okay, great. So the reason why I think what happened was banks were using very conservative credit models. Often if you go to a bank and you ask for a housing loan or a car loan or whatever loan in Asia, they will look at one important data set, and that is your credit bureau scoring. So that credit bureau score dictates almost everything, right? Of course, they'll do background checks, they'll look at your income, they'll look at a lot of other smaller data points, but that credit score dictates everything. Now, the problem is, if you have never taken financing in Asia, if you have a job that pays a fairly low salary, but probably a stable salary, you may be at risk whereby banks reject you, because it's all about historic data. It's all about your credit score. And we found that in China and, in parts of emerging Asia, there were large segments of retail clients that were being rejected. And I might add, quite unjustifiably at times, because these people did have stable incomes, as we later on found out after we read reports on the P2P platforms onboarding certain clients. Now, here's the interesting thing. We did some work early on in 2015 with some Chinese P2P platforms that were building alternative credit models. It was amazing how they were extracting data from online purchasing platforms, from telco data, from social media on individuals. And when we started working with them, because we come from a traditional credit risk management background, where we would have, credit models, we were asking them, look, what is the point of getting data on someone's, we understand spending habits, but why his character? Why would you look at what someone does in their spare time? And one of the Chinese companies that was pretty progressive told us something very interesting. Traditional credit models measure your ability to pay back a loan. We want to go beyond that. We want to measure your ability, but as well as your willingness to pay back loans. We want to look at the character of a person to determine whether this person is suitable from a moral standpoint, because he may not have the ability today, but he may, if we give him a window of time, he may come up with the money to pay back. So that was really fascinating to us. And so using alternative credit models, a lot of these Chinese P2P lenders were able to onboard a large segment of the unbanked population. It wasn't only the credit models. They had easy access to funding through sophisticated mobile apps. It was easy to use, minimal due diligence, none of this paperwork. A lot of this was digital online questionnaires that you had to fill out. And from an investor perspective, by the way, the investors also did really well. 10% returns. Some of them made 10% returns on short-term tenor loans, right? So everyone was happy until recently, until 2018, when the Chinese authorities decided, you know what? The shadow banking and the P2P platforms, they're growing way too much, too quickly. We're going to put some regulations in. We're going to come down hard. And guess what happened? P2P lending institutions who were around about 2,000 institutions in 2018 collapsed to 1,000, 50% in the present year. The latest figures show about 1,100 in August, right? Massive. And that was because of harsh government regulations. And I don't mean to be subjective. I'm not saying it was a good or bad thing, but I guess these are fintechs, right? They weren't prepared for sort of banking regulations. And then what happened was that there was the famous news of Tuandai and Hongling Capital, two of the big P2P players, also collapsing. The government then realized that, okay, you know what? This is having a systematic risk on our population. So they went back to banks and they said, look, can you onboard some of these clients? And they sort of loosened the restrictions on P2P players. But it was too late because banks said they're not interested. So I think the key point is it's a philosophical sort of story that we've got to ask ourselves, right? First of all, should banks be the only one providing financing because they're regulated entities, right? Second, should banks learn from P2P lenders? Is it time that they also pursue an alternative credit model? Maybe there are segments out there that deserve a loan, deserve financing, but they just have been too rigid, right? And the answer to that is that, and also third question is, did the Chinese regulators intervene too early? We all know that, if regulators intervened in sort of, in the early 2000s, or even in 1995 when the internet was coming in, we probably wouldn't be where we are, right? So, there's no yes or no answers, no right or wrong answers. We don't have enough statistics and data to do any back testing to show whether these alternative credit models worked or not.
Right.
So we don't know. But I think it's food for thought. That is, look, banks are restricted by balance sheet and regulations, and they're already profitable. Alternative sort of platforms like P2P platforms and non-banks have sophisticated technology, but maybe they don't really quite understand regulations. So I would leave it up to the listeners to ask, what is the optimal solution?
Right. So we've talked a bit about the banks.
Mm-hmm.
We've talked about fintechs. So to complete the trident of the conversation today, can we discuss a little bit about capital markets as a viable alternative? Perhaps you can start by giving us an overview of why capital markets haven't taken off as the primary funding source for Asia.
Okay, yeah, great question. And I'm not the only one who's looking at this. I guess there have been a lot of debates on why. Why is it that capital markets haven't taken off, right? So, look, before I start off on being too negative, let's look at the short-term data because there is some positive trends, right? So again, McKinsey white paper on a digital future for Asia's capital markets shows that between 2015 and 2018, issuances grew from 2.5 trillion to 2.7 trillion in Asia. Okay. That's one. And specific to debt capital markets, so on the bond side, we had issuances grow from about 2,800 to 3,500. And from a SME perspective, SMEs are starting to come into the bond market. There were about 300 SMEs in 2015, and 2018 there was about 570, right? But look, I wouldn't, just because the numbers are growing doesn't mean it is growing consistently with the financing needed for Asian growth, right? Because Asia is growing much quicker than these figures. And not to mention that a lot of these figures, so 46 or 50% of these issuances are actually in mainland China. So it distorts the figures a bit. So we can't be overly optimistic about this. So the region is a bit fragmented when it comes to capital markets, especially fixed income markets. So the advanced countries have always been Japan, Hong Kong, Australia, South Korea, and then probably Singapore, and then Malaysia, Thailand are in between, and then lower down the spectrum we have Philippines, Indonesia, and Vietnam, who really need to work a lot harder to get their capital markets flowing. But now that I've put things in context, let me just give you some examples of why I think the fixed income markets haven't really taken off in Asia. First of all, statistically, the capital markets are dominated by large corporations, not so much SMEs. And this is because the cost of issuance as well. Traditionally, I think that the SMEs we certainly talk to have said that, they don't really want to go through an investment bank that charges them, a significant percentage of the fees just for raising capital, right? And there's not a whole lot of knowledge as well. What is how do bond markets, how does a bond market syndication work? So there's been, that sort of factor where they've been intimidated by it because of high fees and low knowledge. Also, look, even if you look at the bond issuances here in this part of the world, the tenors have been fairly limited. And there's an absence of secondary market. So, the trading is quite volatile with little liquidity. We're also looking at the interesting factors. Government bond issuances in this part of the world also is quite low. I mean, certainly Singapore is a great example. Singapore runs a budget surplus of about 2 billion. So the question is, why would Singapore even need to issue bonds, right? And the answer to that is it doesn't. It only issues government bonds for benchmarking reasons, so that the corporates who are issuing bonds have something to benchmark against.
Right.
Yeah, so quite interesting. The main 2 points that I think are significant is that access to local bond markets is often not as simple. There are barriers to entry, which I can elaborate on later on, both legal, regulatory, and other barriers. And also the whole post-trade side of things is complex. The post-trade, the settlement, the custody, it's fragmented. So all of these factors make the bond markets in Asia sort of rather unappealing to a lot of the both global investors and local investors. Having said that, I need to just say one thing though, is that local banks, like regional banks, have done quite well in the bond markets as far as issuances go, and maybe we'll talk a bit about that. Regional banks have really come in, and they have, as far as local bond issuances go, they have really taken a lion's share of the market. About 50% are dominated by regional banks. One, they have strong balance sheets. Two, they have a subsidiary model around Asia, which means that they can use their local subsidiaries to access local markets. And three, I think the regional banks understand local clients better, right? The cultural side of things. So now let's really talk about why is it important to have thriving bond markets in Asia. So my answer to that would be, it's actually not. Having individual bond markets that are deep and liquid, yeah, sure, can be helpful, but it won't really make a difference. We need to go back to first principles and ask ourselves something. What are we trying to solve? And this is what we're trying to solve, I think. We are trying to move capital from areas of high wealth in Asia, where funding is needed, growth areas. And we think traditional finance theory dictates that capital markets are the most efficient and cheapest means of doing that, right? Mm-hmm. That's the first thing I want to talk about a bit. So we can't look at Asian bond markets as a set of individual bond markets. We need to look at it as a region. So even ASEAN, we should have a single bond market just for ASEAN. And that would be the most effective way of moving capital around. That's the first thing. And the second thing is, again, Asia doesn't have a healthy secondary bond market, right? And I want to talk a little bit about those 2 points, if you don't mind.
Yeah, of course.
Okay, great. So the first point is, how do we create a sort of a single unified regional bond market, right? And there's been so many attempts at this going on for the past 10 to 15 years. The Asian Development Bank has tried it. The Asian Bond Market Initiative. There's been series of central banks like BOT, Bank Indonesia. There have been tri-party agents like Euroclear. They're always talking about harmonization and creating, growing bond markets and all that. But honestly, look, all that is great. It's great to read a white paper, right, on thought leadership, like a white paper that shows, oh, you know what, we're trying to unify bond markets in Asia. But it doesn't work that way. And I'll tell you why. So I worked on a number of initiatives where I've been invited by regulators, exchanges to help in, trying to build a unified market, right? Harmonization. One of the strongest examples I'll use is in 2010, the ASEAN trade link. It was basically the ASEAN nations decided to build an a unified equity market, right? Now, the outcome was absolutely tragic, unfortunately, and I hope I don't sound controversial to the listeners, but let's call it out as it is, right? I'm not here as a diplomat. I'm here as an expert in finance of the Asian region, and let's call out what doesn't work, and let's focus on what does work. So I'm going to call it out, and I'm going to say, having worked a little bit on that project, I just saw every regulator, every exchange, every market participant was so obsessed with following their own sort of post-trade processing or their own regulation on something or their own sort of market practice. And they were trying to protect that and promote that. And it doesn't work that way. If you want a regional platform, you have to just use global best practices and get everyone else to adopt that. And that's the problem I see. I mean, we get bogged down hours after hours, days after days, months after months in, talking about these legacy practices that were like invented 20 years ago. Like, who needs to have, multiple brokers, multiple custodians just to access? If a Malaysian investor wants to access an Indonesian market, they don't need to go through like 2 brokers, 1 custody, 2 sub-custodians, all that. So that was my observation. You cannot do things with, you can't allow bureaucrats to drive sort of financial markets growth. There are regulators and government officials that will be instrumental in ensuring that, once everything's been agreed on, that the local market follows it. But let's leave the build to financial markets experts and technology, right? Technology innovators, basically. You need to have people who think out of the box, who understand both technology and financial markets and products. So that's the first thing I want to say about, building a platform that is key, building a unified bond market in Asia. The second thing I want to say is about secondary trading. Why is it that secondary trading in Asia is so thin? Now, why is it that if you look at the custody, if you look at the bond market, or if you look at custody assets under utilization, the Asian custodians have a less than 10% asset under utilization? What does that mean? That means that, institutions park assets and hold their assets. High net worth, they hold their assets almost till maturity. Why is that? Why don't you have a financing market? Why, if you have assets that are parked in your custody, why don't you ever think of, if I lend this out for overnight roll or a 1 week or a 1 month, I can make X basis points. And for this, we need to look back. It's a cultural thing in Asia. Traditionally, even rich Asians like to buy gold or real estate and hoard it, right? I have, and I'm not joking, I have a neighbor who lives on top of me who used to be an ex-journalist, but he's done well for himself. He made a lot of money. But he actually has gold bars in his safe, in his apartment, which are worth like about 70% of his entire pension, right? And that's the thing, right? It is a cultural trait that is even followed by institutions. So it is essential that Asian institutions start thinking about, secondary markets, secondary trading. This is something that we will touch upon when I come to talking about technology and so on and so forth. So those are the two key points that I wanted to make. If you want to grow if you want bond markets to be a significant part of financing for the next 5 years in Asia, one, you need to unify this region. You need to make a seamless flow of capital from high net worth areas into areas where financing is needed. One. And secondly, you need to have secondary trading, whether it's repo markets, whether it's securities lending. That has to come, because once that happens, you get new client segments come in. You may have hedge funds coming in, taking advantage of volatility. You may have custodians. You may have lenders and borrowers come in, taking advantage of the financing, right? So those are the two key points I wanted to tell you. Yeah.
Right. I mean, that's been a lot of information all at once. I think we covered a lot, regulation and the regional difficulties. But I think if we want to focus more specifically on the solutions, you mentioned the unified platform.
Yes.
Would you mind going a little bit more in detail about this?
Look, I wish we had another hour. I would talk so much about different things.
We can go as long as we need to.
Okay. No, I mean, look, there is one part of it that I am quite encouraged about, and that is just electronic trading platforms that are coming in, right? Bloomberg, TradeWeb, MarketAxess, they've done quite well. And they have managed to streamline a lot of both the OMS and execution, but also the post-trade, right? They've managed to access Chinese markets through Bond Connect and all that. But I want to take this conversation out of the box. I want to focus on something a bit more innovative, right? So here's the premise of it. If Asian borrowers are comfortable with borrowing from banks, and also something that we didn't mention, private debt, if they're comfortable with that, and if that's how if private debt and bank lending, the combination of those two, are financing Asia at the moment, then let's keep it there. Let's think about it this way. How can we grow that and encourage that, but at the same time grow our capital markets? So that's the $1 billion question, right? So here's one of the solutions that we're working on, right? So one, you take the bank loans, institutional loans, you take the private debt, you repackage it, you securitize it, and you sell it off as capital market notes, right? This will enable banks to free up their balance sheets so they can issue more. Mm-hmm. And at the same time, the investors who are buying the capital market notes, gets sort of senior secured long-term note, right? That's collateralized by either real estate, commodities, or whatever the underlying is, supply chain. Now, I know what you're thinking, Thomas. You're saying, how is this any different to securitization or CDOs? I mean, that's nothing new.
Right.
But here's the, here's where it becomes different. What if we do this on a blockchain platform, right? If we do it on a blockchain platform, then we avoid all the pitfalls that happened during the 2008 financial crisis, where the investors who were buying these AAA notes thought everything was rosy and great, but the underlying loans, they didn't know what they were. In the meantime, you had all these delinquencies and defaults in the housing sector in the US, right? There was a complete mismatch. What if technology solved that? So let's look at what we're working on. And I'm not here to promote myself at all. I'm just excited about this and I'm sharing it. So what happens when you put everything on the blockchain? And I mean everything, not just the borrowers and the lenders, but the investors, for example, the credit bureau, the ratings agency, the regulators, they're all on the blockchain. Okay, so let's talk from an investor perspective. They've just bought a note, a capital market note, but which is a repackaged note, and the underlying is all the private debt and a mix of private debt and bank loans, right? But in this case, the investor gets to have a full view of every single underlying, whether it's 50 or 100 underlyings. More importantly, they get to see real-time performance of all the underlyings. What does that mean? That means every single interest payment that's done, every single principal pay down. If there is a single interest payment that's delayed, a smart contract would trigger an alert, and that alert would be sent to the investor, to the ratings agency, to the credit bureau. If there's a default, same thing happens, but the regulator gets involved on a real-time basis. And that means that the holder of the capital market note would immediately, they would be able to adjust their pricing right away, right? This would not be like the financial crisis where months and months went by and none of the investors knew what was happening in the housing sector. So this is something that we have been working on with the Chinese, both institutions and exchanges. And we think that this will be revolutionary because it's the first time that you have a real-time view, right? Secondly, also, the collateral is a big factor in Asia, right? Because if you're pledging real estate, if you're pledging commodities, aluminum, all these different things, right? How would the end investor or even the bank know that it's legit, right? And what do you have at the end of the day? If a real estate company is getting a loan on the back of 50 or 100 apartment blocks they're building at the moment in 7 separate locations, and if that's your collateral, how do you know? I mean, you can do due diligence. Maybe you'll do due diligence on 5 of them or 10 of them, but does anyone in Asia have the resources to do due diligence? But technology solves that. Again, we have seen basically RFIDs or 360 virtual cameras. We have seen high ultrasound devices. We have seen infrared devices, all of which are tracking real-time movement and silhouettes of any building or objects, right? So at the end of the day, if a note holder is holding a repackaged real estate, a repackaged debt, right, which has 50 underlyings, out of which all 50 have been collateralized by real estate projects, they can go into their mobile phone, they can look at the pricing of the note, they can look where it's trading, but they can also look at each individual underlying as well as the collateral. They can actually look through color coding to see, you know what, I've paid X amount for this percentage of the housing project, and I can see a real-time imaging of that housing project, right? Now, I know that you may look at me now and think, well, that's a bit far-fetched, but trust me, from a risk management perspective, having real-time view of your underlying collateral, which can be a building, can be commodities, can be anything in a warehouse, but having that real-time view, a lot of institutions would feel a lot more secure, right? Mm-hmm. So I'm giving you an example where, you asked me, what's the solution? Is it banks? Is it fintechs? Is it capital markets? Well, this combines all three. We allow banks to keep lending. We allow them periodically to free up their balance sheet by selling off all their loans to a third party, maybe an investment bank, who repackages it and sells it off to the capital markets. And at the end, the risk and exposure is held by an investor base of clients, right? So we think that this is a first step. And I'm giving an example. There's a lot of other examples I could use. But also what I didn't mention is, going back to tying it down to SME financing. Well, SME financing can also work on this model, but here's the thing. There is a lack of data on SMEs. So what the blockchain network needs to do is create an SME repository, right, of data points, so that any one point in time, any investor wants to go and look at SMEs, or even in the bank itself, it can look at, what's the SME on a real-time basis. It can look at all the data that they need from the SME. What sort of collateral they're using, what sort of revenues are they making, what was their monthly earnings. So these are key factors if you want to combine technology with capital markets and banks to produce the right platform. Yeah.
So how far are we from a platform like this?
So again, it goes back to two things, right? Yes, so this particular platform is being developed in China, but let's again go back, shift our focus to Asia or even to ASEAN and ask ourselves, a question that, what would it take? What would it take for, let's say, ASEAN to have some sort of financing platform like this, whether you want to call it a bond platform, fixed income platform, whether you want to call it a securitized platform. So the first thing is, again, we need to get the ASEAN countries to stop being so obsessive about their own local organic policies, procedures, and processes. They need to step out of that. They need to stop thinking that, the world revolves around my country. It doesn't. If you really want to optimally benefit from being a part of the ASEAN region, you need to think of yourselves as a part of the ASEAN region and embrace the fact that, we'll compromise our own policies and procedures for the good of the whole region. Because at the end of the day, everyone will benefit. So in technology, we have two concepts. One's called out of box and the other's called highly configurable. When it comes to a lot of the local institutions in Asia, they want a highly configurable solution. What does that mean? That means, this is how we trade, and after we execute a trade, this is how we confirm our trades, this is how we do our reconciliation, and this is how we do our settlement. And we want you to build your platform or configure your platform around these. That needs to go. The regulators, the market practitioners here, the exchanges need to embrace the fact that, look, let's all embrace best practices. Let's come up with a set of best practices. Let's forget what we have as legacy and let's embrace that and let's put a platform in place. So that, I think, is the most important thing, especially on the post-trade side. Execution, affirmation, confirmation, reconciliation, dispute, settlement, custody, and asset servicing. This is what a life cycle of a trade is, basically. But if you move to blockchain, which is a single source database, you get rid of so much of this. You don't even need reconciliation because everyone is using the same instance of real-time data. So a lot of this will collapse after you execute, depending if you're using proof of work, proof of stake, but from execution to settlement, which is just really a book entry ledger update, should really take 45 minutes. Mm-hmm. So all of this will be, sort of collapsed. The question is, is who's bold enough to make this move? Even in ASEAN, which country is progressive enough to say, we'll take the lead. I'll put my hand up. We'll take the lead. I would say Singapore is. They're the most progressive, but I don't necessarily think, even if Singapore wants to lead a project like this, I think someone in ASEAN is going to go, no, we like things the way it was done. Possibly Indonesia. I don't know. But so it needs visionaries. It needs to let go of legacy practices. Yeah.
In your own words, in a few words, I'd rather say, what would you like the audience to take away from the conversation? Really, the thesis of the message that you'd like to get across to the audience.
Yeah, good point. So I would just, maybe three or 4 points here. Okay, first of all, let's wrap up here and talk about how this started. We today are in a period of time where the geopolitical global environment is very uncertain, and I would say unstable as well politically. Global growth as well has slowed to just above a recessionary level, right? And this has caused us to move to close to zero rates globally. As a result, there is tremendous focus in Asia, especially from the global investor segment. And this focus too has changed. Asia is not about, let's pick up some yield. Asia is about, let's invest in the long-term growth of this amazing region that is so energetic and innovative and has so much prospects. So that's changed, right? But from an Asian perspective, let's not sit back and just say to ourselves that, you know what, the global environment is actually favorable for us, so happy days ahead. No, I always believe that nothing happens in life if you just sit back. Asia should recognize this moment and say to themselves, you know what? We can actually make tremendous advantage of the global environment and the capital inflow about to come. So we need to fix some of the things inherently in Asia. We need to focus as one region, right? We need to focus as one region, and we need the banks, the fintechs, and the capital markets to also focus as one region. And that means that we need to allow seamless flow of capital from asset holders to growth areas where capital is needed as seamlessly as possible. So, we need to build the right channels of capital flows through the use of sophisticated technology. And then we need to get buy-in from regulators and government officials to standardize these workflows. So those are things that we need to do. I think this is a tremendous opportunity for Asia. I'm traveling so much these days around emerging Asia, from places like Vietnam, Indonesia, even places like Bangladesh, and you wouldn't believe the amount of energy and ideas there is. There are people who are talking about, building eco resorts in places like, just around the region. There are people who are talking about, there's just so many ideas. I can talk about it for hours, but the fact is, look, this is the time that Asia needs to really, really believe that the time has come. And Asia can make a great leap forward in the next 10 years, a great leap forward. All the eyes are on Asia. Capital inflow is really coming this way, but Asia really needs to fix its inherent flaws before we get anywhere.
Well, it's enthusiastically optimistic, but no, it's great. So if we have some curious and proactive listeners who want to reach out, and continue the conversation offline, how would they reach you and your team?
Yeah, so I mean, they can reach me through email. I think that's probably the best way to do it.
We'll put the link in the description.
Yeah, and I'll give my my direct number as well.
Okay.
So
great.
Yeah.
Well, thank you again,
Thomas. It's been a pleasure. Thank you very much indeed.
This was very interesting.
Thank you.
So as a reminder, we are hosting live broadcasts every month, so sign up on our website for free and subscribe to our YouTube channel. And ladies and gentlemen, this has been another episode of the ICC Livecast. See you next time.